Hello, everybody. It's Gareth here from Paris Technologies. And today I'd like to share with you 5 simple tips on how to do an easy foreign currency translation and group consolidation. Let me share my screen. Okay. Tip number 1, don't try to do this in Excel. It's kind of tricky. It requires us to maintain some really good history. So you're going to want to get yourself a really nice consolidation tool. I'm going to recommend Paris Technologies Power Excel. I'm going to give you a nice demo of that after this video. All right. Tip number 2, keep 2 columns, one for local and one for translated currency. Don't try to have separate columns for each different currency. You're just going to stretch your reports out over the page, which you don't need to. I'm just going to give an example of what I'm talking about. So here I've got my entities down with the currencies that they use, but I'm going to do all of their local income statement or local P&L and balance sheet in one column, which I'm going to call local. I know the currency that's related to each of these, and then I'm going to have a foreign currency translation amount or rate, and then I'm going to have my consolidation currency, which in this case is going to be dollars. So nice and simple, 2 columns. All right. Tip number 3, keep it simple. Just use one exchange rate per month. Translate everything at one exchange rate. Nice and simple. But I know that people are going to worry about the accounting standard. So I've just listed a summary of both standards. Here's the international one. Here's the American one. So for both of them, it's simple. Assets and liabilities are at the closing rate or last exchange rate. So it's just one rate. So we understand that. No problem. For the international one, it says income and expenses at the actual exchange rate on the date of transactions. Okay, so it's imagining quite a lot of different rates. And for the American one, it says weighted average exchange rate for income statement accounts. So what I would suggest is that if your exchange rate is fairly stable, and when it comes to this kind of translation work, you have to take a practical approach. So if your currency exchange rate is stable, then one rate will be a good approximation for all the different rates of all the different transactions in the month. So I think it meets the international standard. For the American standard, where it says weighted average, what I'm going to show you is that if you keep one exchange rate per month for each month of a year, you will then get a weighted average for the total year. And I believe it's going to match this accounting standard for you. And then finally, it says historic exchange rate for the equity accounts needs to be maintained at historic exchange rates. Now that is where tips number 4 and 5 are going to come in. All right, in order to maintain historic exchange rates, tip number 4 is maintain multi-year retained earnings and link up those balance sheet accounts to the actual P&L or income statement of that year. That way, we're going to translate the income statement at those closing exchange rates. We're going to have a weighted average historic, and the equity accounts will roll into the balance sheet at those historic rates. So that's going to solve that problem. And then finally, use journals to match share capital with investment in subsidiary. And I'm just going to show you what that means. So here on the left-hand side, I've got what the standard, if you read the standard directly and how you might want to do it, here's an example, right? Very simple. You've got a company in Europe and you've got a company in the US. And the US invested in Europe when the exchange rate was 1-to-1, and now it's 2-to-1. So very simple. And for this example, there's no P&L effect. It's just balance sheet. So now we see that the European translation would be 0.5, 0.5, and 1 for the historic. So you would get this balance sheet in dollars. And then the USA's balance sheet's like this. And then we know we need to eliminate the investment in subsidiary. And we need to eliminate the share capital from Europe. And because we've kept that historic exchange rate, it's very nice and simple. And then the balancing number is the FX translation reserve. And you can see that's our group balance sheet. Now, if you do it the way I'm suggesting, and we use a single exchange rate, what will happen is the initial translation will be different. The European balance sheet will be different. But when we come to do the journal to eliminate, we know that we need to eliminate the 100 investment in subsidiary, and we know we need to eliminate this translated 50 share capital. And then the difference, all we need to do is put the difference to FX translation reserve. And then you sum across. And what you'll notice is the group balance sheet is identical. And you please feel free to do this at home and try your own different exchange rates, different investments and things like that. But what you'll notice is that it comes out the same, whichever way you do it. And remembering at this translation level, you're always going to be reporting at this group level. So it gets you there, and it gets you there nice and easy and simple. All right, so that's it. That's my 5 tips for really nice and easy, simple foreign currency translation and group consolidation. Now, let me jump into a demo now and show you this working in a really nice tool.
All right. Let us roll back to the beginning of time, 2022, and let us see my subsidiary in its local currency, which is euro. So here I have the parent company in the US in dollars, and I've got the subsidiary in Europe in its local currency, which is euros. So you'll notice that we purchased this subsidiary with $100, and it shows 109 euro share capital, and that's because the exchange rate at the time of purchasing was 1.09. Everything's perfect. And then you notice I capture a single exchange rate per month or period. Here I'm showing you simply in quarters, but I'm one exchange rate per period. Okay. Let us roll forward a year, and let us flip this to our translation currency, which is dollars. All right. So what you'll notice is I have my retained earnings by year. And you'll notice that for prior years, it's the full year's retained earnings for every quarter, and it stays linked to the P&L. And the reason it must stay linked because we need to use the weighted average of the exchange rate. So if I go and change an exchange rate here, 1.5, it's going to change the P&L, and I'm going to keep it linked. And so it's going to bring back that retained earnings. Okay. You'll notice for this year, I have the year-to-date numbers per quarter. And again, it's linked to the exchange rate so that if I change an exchange rate, everything changed. If I go 1.02, for example, my balance sheet changes, my income statement changes, and I keep it all linked. Very simple, and it works with the accounting standard. Okay. What is my one issue that you can see? Well, here, you can see that my investment in subsidiary was always $100. But here, when I translate the capital section, you'll notice it keeps changing. And how do I manage that, right? Well, you manage it with a journal. So let's have a look at how that journal would work. Here, my investment in subsidiary at the group level should be 0, so I journal it out. I should only have the 100 share capital in my parent company, so I journal out the subsidiary's share capital, and the difference, I just put the journal to the foreign currency translation reserve. I just put it there. It's just the balancing number. And then I add up all the foreign currency translation reserves to give me a reported one. Now, when I first saw this with a multinational in Asia, I didn't believe that it would work, and it would actually give you the same result as doing the historic rates. So I went out to prove that it wouldn't work, and I just proved that it does work. It actually does work. It's simple, and it works, and it applies the accounting standard. So those are my 5 tips in 5 minutes. Thank you.